The first sign for credit tightening usually appear well before the recession or major financial stress becomes obvious. Lower loan to value, LTV, this is often the earliest and clearest sign. For example, 75 to 80% LTV becomes 65-70. Any of you have applied for a loan in the last 6 months or a year, even some banks were earlier to address it than others. You know exactly what I'm talking about. So, what are the first signs for credit tightening? The first sign for credit tightening usually appear well before the recession or major financial stress becomes obvious. In agriculture and farmland markets, the sequence is often quite predictable. Lower loan to value, LTV, this is often the earliest and clearest sign. For example, 75 to 80% LTV becomes 65-70. Then lenders start asking for 50-60 on larger or riskier transactions. This forces borrowers to contribute more equity. So then number two would be like more scrutiny of cash flow. Lenders begin focusing less on collateral value and more on repayment ability. They ask for what happens if commodity prices fall, what happens if interest rates rise, what happens if yields decline. Loans that would have been approved automatically suddenly require detailed justification, taking a lot longer, in other words. Increased collateral requirements. Banks may ask for additional land security, personal guarantee, cross-collateralization of multiple assets, land, your operating costs, your equipment, and so on, cross-collateralized. The borrower may still get the loan, but with more asset pledged. And then it goes on to slower approval times. If any of you have applied for a loan in the last 6 months or a year, even some banks were earlier to address it than others. You know exactly what I'm talking about. Credit committee become more cautious. Credit committees. You start hearing the bank is taking longer. The head office wants another review. We need more documentation. This often appears months before major credit problems become public. Okay, then the next one would be higher interest spread between the GOCAN and the bank rate. The central bank rate may not change, but lenders increase their margin. Example, prime plus 0.5 becomes prime plus 1.5. Fixed rate loans become noticeably more expensive. And then number six, reduced appetite for large transactions. Contrary to most people's thinking, they think the large operators always have an edge. That's BS. The banks are more leery about large operators, and they make them these items have been implemented, and doubly so for large operators. Okay, so then there's large borrowers often notice tightening first, as I said. Lenders become hesitant about large farmland acquisitions, expansion projects, leverage buyouts, speculative investments. And then they want more loan covenants. New loans beginning, including minimum working capital requirements, debt service coverage ratios, up instead of going down, of course. Net worth requirements, borrowers lose flexibility. So declining asset liquidity, this is often overlooked. You start seeing fewer bidders at land sales, longer selling periods, and there's longer on the market, more details falling through due to financing. Price may still look stable, but liquidity deteriorates first. So that's exactly what I meant about financial squeeze. It's not all of a sudden they cut it off or something like that. But this is going on regardless of how the commodity prices, wheat, the grains, the pulses perform, because you have to have 1 year of good performance so that before the bank gives you credit for it. So this will go on for, I'd say, at least a year or so.